Hey guys, it's Chris Mincola with the Mincola Group over at West USA Realty. Hope you guys are doing well. Happy Mother's Day to all the mothers out there. Hope everybody is having a great weekend. Um, it's definitely tricky, on Mother's Day, with all everything going on. So everybody stay frosty out there. Okay, so I hope all of our mothers have a wonderful, wonderful weekend. But anyway, guys, this is going to be pretty interesting stuff. I want to give to you today. Last week we talked about there being about 56% of home sellers reducing the prices on their homes. The median reduction was $10,000. So here's some other things to think about. I get this question a lot. Let me share my screen here with you really quick. Um, I get this question a lot is, Chris, how are prices still going up? This has to come down at some point. Well, again, just like anything else out there, it's all about supply and demand. And, as long as there isn't an excess of a product, there's not an oversupply of a product, then and there's still demand for it, then there's going to be that price increase. Okay. There's going to be that inflationary factor there. So, one of the things, I pulled this out from Redfin, it's housing market update. For the first time in nearly 2 years, there's no major American metro where home prices are falling. Okay. So why is this happening? What is going on? This has got to be another bubble, right, Chris? Well, that's not how it works. You know, the a few things that we gotta kind of get out there for people to understand. When we had the housing crash before 2008, it really started back a couple years before that, but we had an overabundance of homes, overabundant across the country in the Phoenix area. In the Phoenix area, it was around 56, 58,000, depending on the week in the month that you were looking at it during that period. When we hit that, and then across the country, we were running, around 4 million, homes for sale. Typically, we have a little bit over a million homes for sale if we're lucky. The real number is about half that when you look at what's actually actively available that hasn't gone under contract yet. And when you break that down to what has actually been built or specced out already and ready for sale, and you can move in within, say, 30 days or 60 days, that takes us down currently to about 89,000 homes. Yeah, not a lot when you kind of break it down across the country. So, and I'm gonna kind of build that out for you a little bit, but just to kind of go back for a minute, why is it so hard to get back to 2019 inventory levels? Um, you know, uh, Prior to the pandemic and the crazy price spikes and everything, as far as inventory levels, especially for single family detached homes, right? Well, going back to 2010, the housing market changed a lot. Where before it was easier to get credit, and it was, and more of it, and it, especially was from 2000 to 2005, right? But that isn't the case anymore. Once you had things like the Patriot Act come in and the crash, Patriot Act, was things like we've got to, have your money sourced. Even if you got a gift, it's got to be sourced as a part of a loan. All those little things. And then when the crash happened, there was some of that other, pre-qualification, pre-approvals that needed to happen. Um, with running credit. It sounds foreign today, but yeah, running credit, looking at debt to income ratios, looking at income, and actually backing it up with documentation, showing that you've been at a job or your own business with tax forms over the last at least 2 years, things like that. Um, yeah, it was very lax before, very lax before. If you ever want to kind of see that a little bit more, watch The Big Short if you haven't ever seen that movie. But anyway, Yeah, so things changed a lot, as far as the credit and having to be pre-approved. The process of even selling a home was different. Since those changes in laws went into effect, it also spawned the greatest balance sheet of homeowners in the history of America, and the largest job expansion ever. So very unique situations from 2020 to 2024 right now. And we're getting back to those 2019 levels in most areas across the country, slowly but surely, trying to get there. In some areas, maybe we have, some we haven't, some are maybe similar, but maybe a little different from what is actually new and resale homes. What maybe institutional iBuyers are trying to run off their sheets and stuff, as far as stuff that's still sitting there. So home builders, they're not keeping up. They're not the March of Dimes. They're not charitable organizations, right? They are there to make a profit. So um, you know like I said, right now we got about 89,000 homes completed, and those are new inventory. That's new inventory. New inventory is really new build. So we're recession lows. Really, if that continues, we'll be at great recession lows for new builds if that continues. So well, when we look at the resale market, most sellers are also buyers. So that's kind of a wash, right? Um, and then you have the largest wave, a demographic, largest wave of first-time home buyers coming in with the millennials. Now and they're a huge demographic, much greater than like Generation X in numbers, which we talked about before, by leaps and bounds. So you have all these kind of things happening at the same time. So things have changed, 1985 to 2000. If you look at the stats there, people move every 5 to 7 years. From 2008 to 2024, it's 11 to 13 years. Some states are 15 to 18 years. People, are always going to need shelter. They're not going to be living on tents typically with their children. So now imagine if rates dropped and things started moving quicker again. Okay. So builders, will only build to make a profit. And so when we look at these things, and we look at them week to week. Now, last week we had Cinco de Mayo. This week is Mother's Day. So things kind of maybe a little wonky or not really as predictable, not really as normal data, if you will, for those type of holidays, especially in certain parts of the country when it comes to Cinco de Mayo, maybe. So those are all things that always play into this. When we look at things, holidays versus regular weeks and stuff and weekends. So who's buying these higher cost, higher rate and higher cost homes? You've got, first of all, when you have household formations, you have dual incomes typically, today. And then you throw in the higher demographic with the millennials, which are making up this huge segment. Then you have boomers. A lot of them are paying cash. Right now it's like 40% of all homes across the country don't even have a mortgage on them, right? So so you've got a lot of cash buyers also coming along, or people with maybe a lot of equity that they're using to invest in other properties and leverage that sort of thing. In some cases, you've also still have investors. You're always going to have investors. So, we want to see our days on market definitely over 30 days on market. In general, as far as an average, we don't want to see that in the teens like we were seeing 2 or 3 years ago. It's very unhealthy. We want to see it, over 30. So, like I've said before, and like they have told us, you want to watch the Fed when it comes to interest rates, and this sort of thing. You want to look at the Fed, though, when it comes to them lowering interest rates. We're going to be looking for an unemployment rate of about 3.2 or more. And again, this is just what they're looking for. They're trying to tame inflation. They're trying to break the labor sector. And they're having a tough time doing it because they were late to the party. And they kind of don't want to, they're working with Treasury. It is political, in my opinion, but they're working with Treasury and they don't want the rates to go up more. They'll have trouble, with these balance sheets that they have for these bonds. It's already hard enough to kind of work with that. And they don't want to lower it because then, we'll have inflation. So are they going to lower it at all this year? That's a great question. If they do, the soonest would probably, unless something else happens, probably be September. Um, and so 3.2% or higher rate of unemployment. Last week we had jobs numbers around 2.9. That was up a little bit. If you also keep an eye out for 323,000 unemployment claims, that'd be another number to kind of look for. So this is why we see, but we still see these prices continue to rise. And it's got to do with the amount of inventory. Until we have an excess of supply, prices won't drop. So anyway, those are the kind of the demographics. Those are kind of the people. How are people affording this? Well, dual incomes. Okay, this high wave of population and millennials, the boomers who have the equity, have the retirement, have the cash, and then the investors. Okay, so prices are not going to drop until we see an excess in inventory. It's probably not going to happen anytime soon. Okay. According to realtor.com, we are short 6.5 million single family homes. Makes sense. So, but Chris, you said last week that there were price reductions. Yeah, there were people doing price reductions at a very high rate, especially this time of year. But again, remember, buyers are very picky right now. The millennials and in my anecdotal experience with listings we have with buyers that we have, whether they're boomer age, whether they're millennial, whether they're anywhere in between, they're very picky right now, and they should be. Okay, a lot of them are opting for new homes or new home builds because of the incentives that they're offering. Maybe a traditional resale isn't a seller isn't quite ready to compete like that with a new build. So in other words, more than even dropping the prices, which price is a big thing, a very big thing. Not only the price range, but the price bracket that you're in, and which price bracket's getting more showings, what's going to pull in the buyers, how people search for homes, how they get pre-approved for a home loan, all those sorts of things. Very strategic, very big thing that we go over with our clients that are selling a property, but also offering incentives for these rate buy downs like a builder is doing. If somebody goes to a builder and they see everything's new, I get a great room, I don't have the front room that I don't need, or, whatever the case may be. In some cases, I've seen builders where they're even doing front and backyard landscaping now, even turf, along with the incentives to buy down the rate. And these rates, some of them are 3.9, 4.9, 5.9. Um, that's not horrible in today's rates right now. When you see when you see these average rates on TV, those are, usually right now, this past week, they were running in the like low sevens. Okay. Next week's going to be pretty volatile. We'll see how that goes. But those are the average rates across the country. A lot of that is thrown in with retail lenders. We like to work with mortgage brokers or these new home builds that are offering these incentives right there, right off the bat. And an FHA right now, you're going to be somewhere in the mid fives. On a conventional, you're going to be around 6 or low sixes. It's a big difference than what you're seeing on TV. That's just with no rate buy downs. I'm sorry, my allergies again are killing me. So that's with no rate buy downs. So it's a very competitive market when you start, understanding these things. And when you list your home for sale, you've got to really price it properly. You've got to think about these other things that people are going to be looking at. What's around you, what you can do to mitigate maybe what's around you if there's something that's noisy or whatever. Again, I always bring this up, but the 3 to 5% rule is you're not going to necessarily do a kitchen or bathroom remodel, but 3 to 5% maybe to get your home competitively up to snuff if you haven't already, to maybe do some painting inside and out. If something is obviously not working or damaged, take care of that, right? Make sure the home gets a professional cleaning top to bottom, including windows, screen doors, all that sort of thing. Maybe pressure washing the front and backyard hardscapes. Making sure all the landscaping's trimmed back and cleaned up. But that's the 3 to 5% rule of whatever the home value is. You're not necessarily taking down walls or doing those big remodeling things, but if it hasn't had a coat of paint in a number of years, inside or out, or maybe you needed to kind of bring those colors up to date more to what the buyers are going to be picky and looking for today. Those are just some things you've really got to consider to be competitive in today's market. And even in the Phoenix area, right now we're across the board. We're in a very balanced market. There's no advantage to a buyer or seller. Now, every city, every zip code, every little community is going to be a little different there. I'll talk about that in a minute, but those are just all the things we have to really think about. So anyway, there's a huge shortage, 6.5 million single family homes across the country shortage. So one thing also to look for that's going to be something coming up here in the banking sector is the commercial market is in real trouble right now. Now, in the Phoenix area, you may look around in most areas, although there's a few that I'm like, wow, there's kind of ghost town in some of these little areas and pockets. But for the most part, we're doing a lot of building out here and all that. A lot of companies, a lot of businesses coming here, a lot of tech companies, a lot of, even entertainment, medical, all those sorts of things are coming out here, which is great. But overall, across the country, there's going to be a tech sector issue with a lot of the commercial sector. And I'm sorry, there's going to be a banking issue with a lot of the commercial sector. And we could see some are estimating a lot of banks are going to be merged, bought out, or have issues like the banking crisis we had a little over a year ago. Those are all things we could be seeing coming down the pike with that. Also, the rental boom's over. Okay. So, when we see these, when we see the rates drop, we're going to see that because we saw the rate of rents stop going up like they were. The rental boom has stopped. That construction sector is going to be coming out. I talked about that before. That's going to be a big indicator for the unemployment sector over the next coming months and year to 18 months when those projects are over. A lot of that's not going to translate to new home builds or other things. Like I said, certain areas like Phoenix, we do have certain, big projects going on. That'd be great for them. But, for some of these other people, they're going to be out of work. Now, that's usually the beginning trend of another cycle for a recession. Okay. When we do have recessions, we have a poor economy, we do see rates drop. So the housing does well in that context. But as far as rents go, we're going to see a little bit, when rates do drop, we'll see more competitiveness when it comes to buying versus renting, even though buying, if you're going to be in a place 3, 4, or 5 years or more, you're still going to be ahead of the game if you buy. But those are just some of the things to kind of think about. Um, the other thing, let me just share my screen here with you. Okay. So you see low inventory driving up prices, home buying demand is softening as rates rise. And the other article here that I pulled is housing market update. Record high monthly payments chill spring selling season, but declining rates could boost activity. So this past week or two, we saw rates drop a little bit, especially since we had a jobs report come out. That was good news for interest rates. But remember, the labor market has not broken yet. It has softened a bit. And again, yeah, a lot of those jobs, maybe part-time, second jobs, even third jobs, all those sorts of things. But it is what it is right now. The supply of homes for sale lost momentum with prospective sellers jittery about rates. Okay. Home sales fell due to high rates and low supply. Rates, and low supply. Keep talking about that. Recent economic news brought rates down from their peak. Okay. So right now, I mentioned this a couple weeks ago too. The monthly that we were going to be at the peak of the price per square foot, and we're already there. We are at a new peak, guys, here in the Phoenix area. The monthly average sales price per square foot is 300 and $309.38 per square foot. So we have a new record. That is it, $309.38. All right, due to that low inventory. But at the same time, like I said, we've got these picky buyers. Okay. So you've got to really, kind of come at this from the mindset of you are a buyer walking into your house. What would you nitpick? Okay. If you're selling a property, if you're buying a house, you can, right now, you can get, you can ask for those buy down rates. Even more importantly than getting a lower price, unless you plan on, being in a house 30 whole years, which most people aren't going to do. And you're really more worried about paying the thing off sooner rather than later or something to that effect. But for most people, they're going to want a lower payment. And, when we say you can get these buy downs, I've seen a lot of people, not only with new builds, but for resales, we're able to negotiate a lot into the deal right now to get those rates down for home buyers. So let's talk about that if you have any questions. But again, if you work with a mortgage broker, you're automatically going to get lower rates. You can, in some cases, you may be able to assume somebody else's loan. That's a little bit more tricky. I've talked about that before. There's a lot of different ways we can do it. One thing that's kind of popular right now are arms too, where you have an arm where it may go up. They brought those back, that they had during the crash. But they may have a 5-year arm or whatever. You got to really understand what those are. Those I might be worth in some cases, but I think for most people right now, you could probably, get a really good deal on a property. And some areas of town are moving quicker than others. I'll get into that in just a second. But here's, 10-year treasury ended up at the end of the week a little bit, nothing crazy. Right now, the usual spread is about 2.6 between the 30-year mortgage and 10-year treasury, which is what kind of controls that or sets that. The spread between the two are about 2.6. Last year, it was half a percent higher. So we have better spreads right now. So when those rates do drop, it's going to be great. It's going to be good stuff. Okay. So let's see. Let me pull. Give me 1 second here. Okay. All right. My computer went crazy there for a second. Sorry about that. The upcoming week will be significantly more volatile. I mentioned that earlier. So that's in the bond market, which sets the rates where they're going to be for mortgages and stuff, back that mortgage-backed securities. So here's where we were. These are the average across the country, taken from the retail sector. I can't stress I can't stress it enough that how much lower the rates are with a mortgage broker. High inflation expectations. Let's see. Keep yields range bound. Sorry, hang on 1 second. I am so sorry. My nose is going nuts here. Okay. So I'm going to wrap this up here really quick for you guys, so I'm not blowing my nose in front of you anymore. But supply is lower than demand. Okay. Supply is lower than demand. The Cromford Market Index, anything below 90 is a buyer's market. Anything above 110 is a seller's market on the overall index. Anything in between is a balanced market. For all intents and purposes, we're in a balanced market, 110.4. Okay. And so supply, looking at 100 being dead center on here, supply is 29 points lower than where it should be, and demand is 20 points lower than where it should be. As far as the cities go, really quick here. By the way, just a quick look. Our overall active inventory, 17,841. When you throw in single family detached, it's only 13,740 for the whole Phoenix metro area. So for the Phoenix metro area, we are in a balanced market right now. Let's see here. What did I have? Okay. This is a quick sheet on what's going on in the area for the averages. So 81 closed days on market. We are at a little over 3 months supply. Absorption rate is way low at 30.56%. The list price, 833,000. Sales price, 629,000. That puts us right up at that all-time high for the average across the Phoenix metro area. Again, we have a new record for that price per square foot at 309 and some change. List the sales price, 97.7. Active, we're up just a hair at 0.5%. This was taken earlier in the week. I just showed you the updated numbers today. Pending, we're at lower pending than we were week over week. So 6.9% drop. That means you've got a little less people out there getting properties under contract. Okay. So again, the rates have been really volatile. By the way, the people say, yeah, well, what does that actually mean? Well, last year at the same time, if you look at the same week, this past week, we were at 6.3% for the countrywide average rate. Okay. For the countrywide average rate. Again, with a mortgage broker today, in those low sevens where we ended up at the end of this week, FHA are going to be in the mid fives. Conventional with a mortgage broker going to be around 6, low sixes. So that's without any buy down, guys. So 6.9% pending. That's down. Okay. That means there's less people out there pulling the trigger or getting under contract. Closed units week over week. Okay. 45.5% down. 45.5% down. Now, keep in mind, again, last week was Cinco de Mayo. People, may have been, people may have been, doing things for that. This week we're running into Mother's Day. That could slow things down for this upcoming week that we haven't seen yet. But here are the price ranges. These are the units within each price range, the days on market we're running in. So kind of at our, middle range here, we're running at 64 days on market, 71 days on market. So it's between 64 and 71 in that mid range. The highest number of inventory between 400 and 599 is 30.95. And a change in percentage there is 61 or 0.661%. So, usual escrow period, if you're not doing a cash deal, typical escrow period is about 30 days ish. Okay. About 30 days. Unless someone's doing some kind of construction loan program and assumable or, something crazy like that, or down payment assistance. Some kind of thing that takes a little bit longer. So yeah, guys, I mean, that's, it just shows that the market has slowed a little bit of volatility there in those rates. Beginning of the year, again, end of last year, beginning of this year, we saw those average rates around 6.6 across the country. Again, affordability factor, people wanting to see what's going to happen. Some people are waiting for the election, all that. Again, I say, if you can afford to, if you need to, and you can afford to, buy a home. It's always going to be a good deal. I mean, if you go, all the way back into, the beginning of time of when they started doing the data, the biggest problem we ever had was during the crash, which was an excess of homes, which were nowhere near an excess of homes. Then they created, really weird lending practices in order to unload those homes for the builders. And then we ended up where we ended up. So, as far as the cities go, guys, Chandler still tops the list at 219 on the Cromford Market Index. Gilbert is next at 179, then Glendale, then Avondale, then Mesa, then Fountain Hills, then Phoenix proper, Tempe, then Scottsdale, Peoria, Paradise Valley is barely in a seller's market. And then we got Surprise, which is in a balanced market. And then the buyer's markets are going to be Goodyear, and then Cave Creek, and then Queen Creek, and then Maricopa City and Buckeye. So that's the story today. Those last 5 there, those are in buyer's market. So the advantage goes to the buyer on where we are right now on the Cromford Market Index and what's happening in the market. So right now, overall, again, we're in a balance, but a lot of those cities that I mentioned were definitely, advantage to the seller in the beginning. And Chandler always tops the list. Very sought after area. A lot of businesses. A lot of kind of the suburbs for that area, east side of town. So there's a lot of companies over there, chip factories and stuff like that. So, guys, if you have any questions at all, let us know. We would love to be able to answer any questions you might have. Send them in. I went through some of that earlier stuff because of some of the questions that we have on some of this. So I hope it wasn't too boring for you. For those who like to nerd out on this stuff like I do, hopefully you enjoy this every week. Please give us a like, a share, a follow on all our platforms, whether it be Instagram, YouTube, and Facebook. And we'll see you guys next week. Happy Mother's Day. Bye-bye.